I'm Chelsey, and welcome to Chelsey's Change, the financial lifestyle channel where we talk about the trips of life. Trips meaning travel, real estate, investing, personal finances, and strategies to living your life fabulously on a dime. Now we're going to jump right into it. What is the thing that you need to make sure you have together in order to live that fabulous life? If you guys said finances, you guessed correctly. And that's what today's topic is. You guys want to check out a webinar that I made on Money Matters 101, where we talk about the basics of money and the things that you need to know to make sure you have your financial house in order. You guys, please give me your feedback, share, like, add me on Instagram, Chelsey's Change, and let's make this trip of life fabulous together. Average spending in America. This is something I just kind of wanted to share. Got it from the Consumer Report. Is average salary is right under $70,000 at $69,181. With debt, almost double what the average salary is at $137,000. I know houses varies, like city to city, state to state, but let's say $200,000. That's a fair price for a house. Around a monthly amount of $1,500. If you have a child, child care, $1,000. New car, $35,000. Food, if you're very, very good at like managing your food budget, $600 a month. Other living expenses, who knows? They vary depending on what you have going on. With this salary, you're looking at a net income, so that's your income after taxes, of $4,300. And you have total monthly expenses of $3,750. You haven't considered cell phone. You haven't considered like utilities, other insurances, cleaning supplies, gas, a lot of the other basic things. And we haven't even factored in fun because, you know, we all love to have fun. And you are that close to your budget. And this is kind of what we are doing here in America. And it needs to kind of really be shifted, how we're managing money, how we're thinking about it, how we're relating to it. So, true or false? Time is money. Anyone can jump in. What do you guys say?
True.
True?
True.
Time is money? Why are you saying true? Who said true? Why do you say true?
Because I equate my money with my time. My time is more valuable, i.e. meaning I can go out to work on somebody's job hours upon hours, but how much is that worth? When I can run my own business, spend a minimum amount of time and gain probably the same amount of money or more.
Okay. That's a fair thing. That's what a lot of people think. So Dr. Travis was saying a couple roundtables ago that money is money. And guess what? Time is time. A lot of times we put emotion behind money. We put emotion behind our time. Whereas really our time is invaluable. And money, the value of it changes on a daily basis. But the real question is, what is money in relationship to time? So we're going to kind of talk about that with the wealth formula. Does anyone know what the wealth formula is? Turn out you do not speak.
Nope.
Okay. So you take money plus time plus or minus the rate of return, less inflation, less taxes, and this gives you wealth. Things that we really need to consider with this are time plus or minus the rate of return, because that's the things that we really have the most, I'll say, control over. You can make more money, but if you don't have enough time, you need to have a higher rate of return, because the things we cannot control are inflation. That's been happening, average of 3% per year, and taxes. Taxes, Uncle Sam wants his cut, so there are ways that we can kind of avoid it, but this is what is taking away from our wealth. And if you want to have wealth, you need to make sure your time and your rate of return are in the positive. Okay. So a lot of times people will say, I'll wait later, I'll wait later, I'll wait later. So just going back is, what is money in relationship to time? $1 today is worth more than $1 tomorrow. So when you're looking at money, in this example, you have $3,600 per month, 8% for 7 years. The other person does $3,600 for 17 years, still at that 8%. They started 7 years later. So they contributed a lot more. But at 48 years old, they have almost the same amount of money. So who's really the winner? So I was just really thinking about compound interest. So what is a bank? What do you guys think about when you hear the word bank?
Someplace to hold money.
Someplace to hold money.
A building that makes money off interest.
Building that makes money off interest.
Definitely.
Right? So according to Wikipedia, it's a financial institution where customers can save or borrow money. We look at Investopedia, you would think they have a better definition. They say a financial institution licensed to receive deposits and make loans. What I say is it's a place where people put their money and allow other people to make money off of it. So how are they doing that? That's kind of just getting to the rule of 72. The rule of 72, this guy, Albert Einstein, came up with it. It says that if you take 72 divided by your interest rate, that is the amount of time expected for your money to double. So in this instance, if you take 72 divided by 72 divided by 2, it's going to take 36 years for your money to double. Divided by 6, 12 years. And divided by 12, 6 years. Now, how many banks are paying 2%? Not many. Maybe a couple online banks say they're paying 2%, but really with the 2%, you still have to have a certain amount of money in there. Most banks are paying less than 1%. So people are sitting and like letting their money sit in the bank, and it will never double. It will never even keep up with the rate of inflation, ever. But we're encouraged to keep our money in the bank, put our money in the bank, save money in the bank. If you ask me, when they say have 3 to 6 months of your emergency fund in the bank, I disagree with that. But we'll kind of go on and you guys understand why. So at age 18, someone invests 2%, someone else invests 6%, someone else invests 12%. When we look at them at 54, this is the amount of time it took for this person, for the 18-year-old to double with the 2%. That's $20,000. But on the other end of the spectrum, the 12%er has $640,000. And the 6% has $80,000. The $80,000 isn't bad, but then you see there's like a huge difference. It's not an incremental, because when you're looking at compound interest, it moves so much faster. So every 6 years, this person's doubling and doubling, doubling, doubling. At 90 years old, the next time this 2% doubles, this is the correct number. It's $40 million, almost $41 million. So, okay. Now let's look at credit cards. Credit cards are a great tool. How I describe credit cards, I say it's like having a handsaw and an electric saw. If you use a handsaw, you'll get the job done, but it won't be as clean and it'll take a lot longer. If you use an electric saw, if you use it properly, you will make a clean cut and it'll get done a lot faster. So there are definitely benefits, but if you're not using them properly, then you're at risk of being in this category where you're making, this is probably a little bit more than a minimum payment. Typically, the minimum payment of credit cards is about 10% of the balance. So a $4,000 credit card, if you make $60 a month payments at 11.99%, it will take 9.2 years to pay it off, and you would have paid a total of $10,620. But if it's a 24.99%, and these are real credit card rates. So variable interest rates between 11.99 to 22.99, 13 to 25, 15 to 24. So this 24.99%, after 10 years, you would have paid $23,000 and your balance is not going down. So here's this house that I wanted. $500,000 house, has a 30-year mortgage. How much do you guys think that you paid for this at the end of the term?
1 million, 1.2.
1.2 is what I was about to say too.
Okay, you guys are guessing high. So remember the rule of 72. It'll take, because with this it slightly varies, because it'll take the 72 divided by so less than 30 years to double, but we know that we're paying down the house, right? So it's not quite doubling, so it wouldn't be at that 1.2, but it is still up there, 728,000, right? So let's look at the same thing, but let's say 4%. Any guesses?
About 800.
So
820.
okay, it is almost 860,000. So 1% more resulted in $130,000 more in interest.
Yeesh.
Yeah. Okay, one more time. 5%.
Million.
We definitely over 1.2 now.
Almost, but it's right at that million. It's at 966,000. So these are things that people really need to kind of consider when making purchases. This is why understanding the interest rate means so much. People are like, well, why refinance? Right now is the time to refinance if you have a house and your interest is above a 4.5%. If you can get a 3.5%, look how much money you're saving.
Exactly. True.
A lot of money. I've heard people say, well, I don't want to pay those refinance fees. I'm like, I'll pay the $8,000 to save $100. So really kind of consider this. And this gets it's better even if you're able to get a 15-year mortgage. I refinanced one of my properties from a 30-year to a 15-year, and my mortgage stayed the same just because the interest decreased so much. So, yeah. So not only did I save in interest, I'm paying the same amount to own the property faster. Okay. So, little case scenario. If you guys had $250,000 cash today to buy a house, what would you do?
Does the house cost $250?
Sure.
I would me personally, I would only put about $25,000 down on it. Let the bank finance the rest, and put a renter in it and let them pay it off, and I'll go buy me another property.
Okay, so then you would take the money and buy another property with it.
Yep, I sure wouldn't, but spend the whole $250 in it.
Okay. So,
I would take the whole $250, buy the house, and then go take out some loans against the house to go play with.
okay. So those are two good scenarios. Trinell, do you have anything?
I would do whatever you say to do.
You'll do whatever I say to do. Okay.
That's not a fair answer. That's not a fair answer.
But
So,
it's the best one I got.
all right, so let's talk opportunity costs. Opportunity cost is the loss of potential gain from other alternatives when one alternative is chosen. So if you were to take the cash, put it in there, then the cash is gone. So you have to then go through the process of borrowing against the house and doing whatever to get the money out to invest in something else. If you take 25 down, that's not quite the 20%. There's all types of things that you'd have to do with that, right? But those are good things because what you all said, none of you said, oh, just take the cash and then live in the house, right? A lot of times I've heard people say, oh, I saved $500,000 to buy my house cash. And I will go on record as saying that is the most foolish thing I've ever heard. And I will show you
Definitely.
that's why.
Definitely.
It doesn't make any sense to me because there's so many ways that we can make our money work for us. The opportunity cost of just paying 100% cash for a house puts you at a deficit. You are leaving so much money on the table. So with this $250,000, right? Rule of 72, bring that back in. If you have a mortgage of 4%, you can get an investment of 8%, which is very reasonable. This is assuming that you do not pay the mortgage down at all over the time period. You would owe $750,000 at the end of 27 years, right? But you would have made $2 million at the end of that same 27 years with a difference of $1.2 million. That sounds good, right?
Mhm.
But what we know is you're actually paying that mortgage down while this investment's going up. So the difference is actually higher. Your actual mortgage balance for a 30-year mortgage at the end of the 27 years is $41,000. And the principal that you paid is $388,000. So that's a little over $400,000 that you've actually paid for this house. So that means that you actually would have made $1.6 million taking that money and investing it and then paying down that mortgage. Who wants to do that? I do. So,
Dave Ramsey discipline.
yeah, I'm like, people follow Dave Ramsey. I'm like, it doesn't make sense to me. It does not make sense to me. You leave so much money on the table. There's so many alternatives to what you can do with your cash and how you can make your cash work for you while still building and leveraging. If you have the access to the cash and you have liquid investments and you're taking out debt at a lower rate, you're putting yourself in a position to win and to grow. So, rule of 4. So the rule of 4 is just a term that I came up with for budgeting and how I believe that things should be budgeted. I believe completely in balance. You need to be able to have fun. You need to be able to enjoy your life. You need to be able to live in a place that you like. But you also need to make sure that you are storing and preparing for your future. So real estate, if used properly, it is an asset. And it can be an asset, but you have to use it properly. That's a story for another day. But you still have your bills and necessities. And then you still want to have fun, still do things. And like I said, you want to make sure you're saving. So this is based off of net income. So net income is what you bring home after tax. So remember, a lot of times when you go to banks, they talk about gross income. They talk about just what your base salary is. But what are you going to do with that? That's not what you bring home. That's not the money you actually have to spend. So you can't consider that. You have to really look at your net income, what you're bringing home. So really, really focus on that, especially when considering where to live. And this is the only thing that I will say Dave Ramsey says that I agree with. If you want things that other people have, you need to be prepared to do things that others won't do. So if that means that to stay at that 25%, you need to have a roommate, then have a roommate. If you need to stay at home or stay, do those things to make sure you're putting yourself in the best financial position. So then your assets are paying for your liabilities. We'll get into definitions a little later. Okay, so make sure you're protecting your finances. People go into bankruptcy because of medical bills, because of car accidents that they're not properly insured for, and then they get sued. And not like now having to the GoFundMe pages to bury people. One thing that people need to remember is that insurance proceeds are tax-free. So they're tax-free. Money that you get from car accidents, tax-free. Life insurance, tax-free. If you have a medical settlement, depending on what it is, that's more of a legal thing, but that can also be tax-free. So think about these things to protect yourself and make sure that you are using things properly to build wealth. Next thing, we're just talking about taxes, the tax strategies. So having things in place to make sure you are cutting the tax liability that you owe. Uncle Sam wants to take everything. Say, here, Uncle Sam, this is what you deserve. This is what I owe you, and not giving him extra. So that's one of the things that you guys come to the roundtables, come to Topic Tuesdays, Health and Wealth Wednesdays, Stock Sundays. These are things that you will have tools in your toolbox to use to build your business, to kind of make sure you're setting yourself up so that $1 million that we're aiming that everyone gets is used and you actually have access to it and you're not giving half of it away in taxes. And then making sure you have stable and liquid investments that I'll say that you can use as savings. So you want to make sure that things are properly diversified and you have your stable funds and your aggressive. So I say liquid and non-liquid. And then with that, with the liquid, you have aggressive liquid and non-aggressive. You have things that are still building and growing and they're working for you, but they may not be as risky as playing in the stock market.
Mm-hmm.
So what are some things? So you have your tax always. So your savings accounts, interest that you get from savings accounts, always tax. CDs, tax. Stocks and mutual funds, if you are doing it actively, that's tax. Forex and crypto, bonds, real estate, as you see, it's in each category. It depends. So if you're doing fix and flips, those are taxed because it's considered ordinary income. Tax deferred, that's when you start looking at your 401ks, your IRAs, a lot of the retirement plans that they've put in place for us to put money away. Reason real estate is here is because if you do a like-kind exchange or 1031 exchange, once again, we'll kind of get into that in some of the later topics, Topic Tuesdays that we have. But these are things that you don't have to pay taxes on today. They're able to grow tax-free, but when you pull it out, you have to pay taxes on it. Mm-hmm. Who can tell me what the tax rate is going to be in 20 years?
If they can, let me know, because I want to know too.
That's what I want to know. So as you put your things tax deferred, know that you're kind of, my sister likes to say, you're making a contract with the government where they can kind of change the terms of the agreement at any moment, and then you have to stick to it.
I usually use an example as if I were to loan you money and you agree to it, but I don't tell you what the interest rate is going to be, would you still take the loan?
That's a good one. So I might borrow that, Marcus. I like that one. So it is. So that's what people need to think about tax deferred. Are there benefits to it? Absolutely. There are ways to kind of manage the tax risk, but it is something that people really need to be aware of. And a lot of times we've been putting money into the 401ks, to our 403bs, IRAs, without fully understanding what that means for us in the future. I was talking to someone and she's retired now, and she's been avoiding, she has a pension, then she puts some money away in her TSP, and then Social Security. So she's getting all of this stuff. At 70 years old, she will be making the most money she has ever made in her life. But guess what?
All taxed.
It's all taxed. Her house is paid for. She doesn't have any businesses. She has no dependents.
Ooh.
She has nothing to write her taxes against.
She is the perfect tax person that they look for.
I told her that we're going to sit down, we're going to come up with a plan. She is going to start a business, and she is going to make use of her time that she has in her retirement, and it'll be things that she can use to kind of help with her tax situation.
I'm glad
but people don't tell people that. They present it as, oh, well, you'll be older, you'll be retired, you'll be making less money.
That is the myth that we've all been sold. We're going to be in a lower tax bracket.
You're putting yourself in a tax bracket where you now are paying more taxes. And
it's pretty much a situation with like Eve and the apple.
Don't bite the apple, Eve.
Let me ask you this.
Yeah.
How would people know to look out for this stuff? Like because I mean, tons of Americans are going to work every day, and none of this information is mentioned to them. And granted, you're doing this live, but like, what what would spark the average person's interest to make them look into this?
Hmm.
One thing that has been sparking a lot of people's interest is the fact that their 401k went down with the market. So
Mm.
they don't look at it as a way to kind of save on tax, but they look at it as a way to kind of protect their initial investment and their earnings. So from there, a lot of times people will then start asking questions. Well, what can I do? What can I do? There was an article that I read that said annuities, the insurance for your retirement. Um, while annuities can still be tax deferred, there are ways to also make a tax advantage. So people, unfortunately, the other thing that I found just in talking to different people, there are sometimes advisors, financial advisors, who don't know all of this information. Some of them do, and some of them
They're not
they're
required to.
your HR departments are encouraging
So as a
tax deferment.
financial
So-
advisors are not required to reveal all this. The only thing that they have to reveal is the charges by law. That's it.
well, that, and then there are some, because I've just talked to different people who they're only sharing what they know. They share the products that they have access to.
True.
So if they don't have access to certain tax advantage accounts, they can't share it. They can't share information that they don't know. So I will say with me, I'm very interested in how money works, investing and all this. There's a few things that I just learned a few years ago that I didn't know going into all of this, because it wasn't something that was ever like, I talked to people who knew about money and they didn't really know about this stuff. They didn't understand how it fully worked.
Yeah, I have one more question for you, because I advise people to do this, but maybe you could say it in a better way. Why did you tell that lady to start a business?
So we're going to kind of talk taxes next week, so we'll get deeper into it. So you guys tune in next week. But when you start a business, there are so many tax advantages, especially with this administration, that people have to write things off. At that point, when she was writing off her house, she was really only writing off the interest. Now, if you have a home office, you're able to depreciate, which means write off the actual value of your house against your income and your earnings. Then you're able to deduct certain things, because in this day and age, as we see today, by having to be home, we're virtual. You need your phone. You need internet. Things that you're paying for already, you're now able to take tax benefits from. If you're meeting clients and driving places, you're able to kind of write off your vehicle. There are a lot of benefits that you get with having a business that you do not get just by having being an employee.
Mhm.
So I hope that answered your question. Like I said, we'll get into it some more next week. So last category we'll talk about is the tax advantage. So this is like your Roth IRA, 401k. You put the money in, like you paid tax on it before, so you don't get taxed on the earnings. Cash value life insurance policies. Insurance proceeds, like if you're paying before, like you put your premium in, insurance proceeds and money that comes from insurance companies, not taxable. And there are a lot of actually really good plans out there now. HSAs, FSAs. FSAs run out at the end of the year, but they're tax advantaged. HSAs, if you're able to contribute, you're also able to invest your HSA. A lot of people didn't know that. But you can invest your HSA and make it grow tax-free as long as you're using it on health. 529, those are education plans. As long as it's being used for education, it's tax-free. Now beware, if you're putting this money away for your kids and then your kids are super smart and get scholarships and you have no one to transfer this to, you can't use it, then you'll be paying like fees and taxes on that. But non-qualified annuities, so that's an annuity that let's say you transfer Roth funds into, and then real estate. So opportunity zone, one of my favorite topics to talk about when it comes to real estate. You're able to take capital gains, invest it into real estate, and in short, after 10 years holding that property, any gain that you've seen in appreciation from the purchase price to which you sell it is tax-free. This is something that this administration did.
Mm-hmm.
Okay, so let's talk about some key definitions. Make it as simplistic as possible. Asset, something that makes you money. Liability, something that costs you money. Liquidity is assets that can easily be converted into cash. So when I think about this, think about stock. That's the first thing that pops into my mind, right? You can sell your stock and that can easily be converted into cash. Net worth, it's your assets minus your liabilities. So if you have a house, the house is worth $500,000 and you owe $200,000, your net worth is $300,000. So return on investment, the amount that you made or lost on an investment. Rate of return, the percentage of gain or loss over time. Actual rate of return, this is the cumulative loss. Excuse me?
Yeah, it's over there. You can take it and go downstairs.
No. Actual rate of return, the cumulative gain or loss divided by the initial investment. An average rate of return, the average annual cash flows generated from the investment. Now, a lot of times people will get very confused with actual ROR and average ROR. So I'm going to stop sharing and we'll just talk about this. So with that, a lot of times we are told, hey, the rate of return on the stock market is 10% per year. Okay, that's the average rate of return. If you have $100 and you get a 50% gain on it, how much do you have?
150.
150, right? Now you have a 50% loss. How much do you have?
On the 100 or the 150?
Of the 150.
50% loss?
Yeah,
What, 75?
you have 75. What is your average rate of return?
75 on 100.
It's 0, right? You had a 50% gain and a 50% loss.
Mm-hmm.
Your average rate of return is 0. But what's your actual?
25% because you're down 25,000.
25% because you're down 25.
Mm-hmm.
But they share average rate of return.
Ooh.
Lies.
Ooh.
So when you look at the actual rate of return, it's very different from your average rate of return. Very different.
Which is why they always like to talk about the average versus the actual, because the average sounds a lot better.
Average absolutely sounds better.